Okay.
YouTube's going.
It's Generation Z, right? The new recent one. Ready? All right, cool.
I actually don't know.
Okay.
Here we go.
Millennials and Generation Z are all asking, can I use my crypto to cover my down payment when buying the house? And the answer is yes. Yes, you can use your crypto, but you have to take your crypto and follow certain procedures to convert it to liquid qualified down payment. What's going on, guys? My name is Min Win with What's a Mortgage. Welcome to our channel. The goal of our channel is to help you simplify home ownership. And tonight we're going to go over finding the perfect down payment. If it's your first time tuning in, do me a huge favor, hit the subscribe and notification button so you're notified every time we go live or post new content. We go live every Monday night on Facebook and YouTube at 9 p.m. and we post content daily on Instagram and TikTok and Facebook. So definitely, guys, if you're not following us on all our platforms, please go ahead and do so. Also, this is an interactive live stream, so ask a lot of questions. And if this video brings you any value, please save this video, share this video, and like the video. It helps the algorithm. So tonight, guys, we're going to go over finding the perfect down payment. Right? Let me ask you a question. How do you know how to finish a race unless you know the beginning and the end? Without a finish line, you don't know how to pace yourself. Same thing with your down payment. If you don't know how to pace yourself, how do you find the perfect down payment? Will you be saving fast enough? And when you save, can you even use that money to cover your down payment? There's two things you got to know about your down payment. Number one, before you start saving, before you start pulling money from this person or that person, you have to make sure that the down payment is a qualified down payment. Can you use that asset to cover your down payment? And number two, how much do you need to save? Some of you guys might already have the money. And some of you guys, as you're saving, it just keeps getting more and more expensive and you can't save quick enough. But if you know what you can use and how much you need, then you'll know how to set your expectation to finish the race. Okay, let's go over qualified down payment first. Before we go over the amount, what is a qualified down payment? There's liquid, which we'll talk about in a second, right? That crypto we're talking about, retirement funds, your equity, gifts, and of course, down payment assistance. I'm going to give you a secret on how down payment assistance works, okay? So those are the 5 types of qualified money or assets you can use for your down payment. Okay? Let's talk about your liquid down payment. Your liquid down payment first, okay? So when I say liquid down payment, anything you can liquidate to turn into cash that goes into your bank account. Of course, you can't go to the escrow with a boatload of money. It's like, here's my down payment. It doesn't work that way. Whatever you liquidate that turns into cash goes into a checking or savings account, and you can wire it to escrow for your deposit and for the rest of your down payment at the end, right? You have to wire it from a checking or savings account. You can liquidate a CD, right? Crypto. You can liquidate crypto. You can liquidate any car, jewelry, or furniture, anything that you can pawn off at a pawn shop. They're going to give you a receipt. You can use that as liquid down payment. Once you receive the money, it's got to go into a checking or savings account and go to escrow. If you have a business account, you can use your business account to cover your down payment. But you cannot liquidate a credit card. Remember that. If you liquidate a credit card and they can see on your bank statement that you liquidated a credit card, you cannot use that. If you plan on using it, I'm not recommending it. As long as they look at your last 2 months of your bank statements and they can't see that you liquidated a credit card, you're okay. But if they see it, it's a no, okay? And this is how you liquidate it. So if you have crypto or something you want to slang or sell, right, this is how you liquidate it. First, you must prove that you own the asset, okay? If you don't own the asset, you cannot use it for your down payment, okay? You must be able to source the money. Perfect example, payroll deposits, the easiest thing to source. If they see that your deposit, if you're a wage earner and you receive payroll deposits every 2 weeks or once a month or every other week, right? That's easy to source, right? Payroll deposits are easy, but anything else that you liquidate, you must be able to source it. Number one, you got to prove that that is your asset first. The lenders want to make sure you're not a straw buyer, right? The crash of 07, 08, from 2002 up to 2007, 2008, a lot of investors were using straw buyers to buy a home, right? They would wire the money to escrow or they did deposit at the last minute because, with straw buyers, a lot of investors wouldn't trust them. They're not going to deposit that money over 2 months. That's why they're going to want to look at your last 2 months of your bank statements to make sure that you already have that money in your account, right? That you've already liquidated the asset. If it's a quarterly statement, right, it could be either 2 months bank statements or an account that's a quarterly statement. What the bank is looking for, they're looking for the last 2 months of your bank statement, the beginning balance of each statement. They want to make sure you have the ability to cover your down payment and sometimes your closing costs as well. Okay. For example, if your down payment is 20 grand, they're going to look on the beginning balance first of the last 2 months of your bank statement or your quarterly statement. If the beginning balance of the last two statements or the quarterly says 20,000, you're good. But if it's not, that's where the sourcing happens, right? Where'd you get the rest of the money to get the 20,000? So if it's crypto, a CD, money from selling any good, you must show proof of ownership, proof of value, and then a receipt must match the deposit. I see the mistake people make all the time. They sell something at a pawn shop for $5,000, but they only deposit $2,500, right? It doesn't match the receipt. So if you liquidate something, it must match the receipt. Well, I liquidated my crypto or my CD and there was little fees. Those fees are going to show up in the transactions. So they know if you liquidate $5,000, you're not getting $5,000. You might get $4,900 and something dollars, right? They're going to be able to see from the receipt. So if you have crypto or anything that you want to liquidate, you must show proof of ownership. So if you went out and you sold a pair of jet skis, right? How do you show proof? You have to show receipt that you actually bought the jet skis, okay? If you have no proof, I just sold a pair of jet skis, they can't use that as a down payment, okay? You have to show proof that you own it, all right? So last but not least, I'm also transferring of funds. If you transfer from one account to the next account, it's okay to use as assets. But when you transfer it, you have to show proof that you actually own the other account. So if the money's coming from Mexico, from the Philippines, wherever it's coming from, you must show proof that you own that account. If it's in another language, banks are going to make you get it translated, right? And get an affidavit and make sure it's real. That's really your account. They're going to ask for the statement, right? So if you're going to get it translated, you're going to need it translated, then affidavit, then notarized to show proof, right? With all the terms on that foreign bank statement, right? So remember, if you're transferring from account to account to account, the more accounts you transfer, the more you have to source. They're going to make sure that you really own that money, okay? So that's how you use liquid money to cover your down payment. Here's a little hack to teach all you guys, right? If you are with a lender that sells a loan directly to Fannie Mae, which is Fannie Mae is a conventional loan, or to Ginnie Mae for FHA, this hack is for you. On a conventional loan, you are allowed one random deposit up to 50% of your gross income. So if you make $5,000 a month and you had some one-time random deposit within those 2 months for $2,500, you don't have to source it, right? If it's an FHA loan, if you have one random deposit, it can be up to 1% of the purchase price. So on a $500,000 home, if you have one random $5,000 deposit, they're not going to make you source it. But a lot of you guys might be getting a loan that sells to another investor. Those investors might have an overlay where they're going to make you source it. But if you tell the Fannie Direct or Ginnie Direct that one time for the 50% or the 1%, they're not going to ask you to source it. So if you have something funky, you might want to go, hey, lender, do you sell to Fannie Direct or Ginnie Direct? Because I have this one-time thing, right? But if not, make sure the last 2 months before you go into escrow that all your money has been deposited. So they look at that beginning balance and they know that you have that money. And make sure your name is on the account. I see a lot of, this is my account, I'm the signer on it. They want to make sure you own the account. You're just not a signer. If it's in a foreign country, they want to make sure you own that account. Okay, so that's how you use liquid assets to cover your down payment. Let's talk about your retirement funds, right? So with retirement, there's 3 types of retirement funds. There's pre-taxed, there's post-tax, and there's delayed income, aka your pension, right? This is what acceptable to qualify to use for your down payment. Pre-taxed. If you have a retirement that's pre-tax, which means the money was taken out before the IRS took their cut and you were able to put it into retirement, you can use that for a down payment. Your 401k, your traditional IRA. Post-tax means the IRS already took their portion and you took whatever money you have left over and you put it into a retirement, which is your Roth or your SEP IRA, okay? This is what you cannot use towards your down payment. Delayed income retirement, right? So if it's a pension, you cannot use your pension towards your down payment. Most pensions, there might be a couple out there that I might not know about, but majority pension cannot be used towards down payment. Also, the 2 popular retirements that cannot be used, 403B and 457. If you have a retirement that I did not mention, please leave it in the comment below. Let us know what it is, and hopefully we can look it up and send you the information. If your retirement is not a 401k, traditional IRA, Roth or SEP, or 403B or 457, if it's a pension, most likely you cannot use it, okay? So this is how you use your pre-tax retirement. So if your retirement was not taxed by the IRS and you were able to use that money to grow, there's 2 ways to draw from a pre-tax retirement: as a hardship and as a loan. Typically, as a hardship, you can draw up to $10,000 without penalty. But because you weren't taxed on it, typically it will be subject to income tax. Typically on a hardship, if you draw from a pre-tax, you can draw anything over $10,000. There is a penalty between 5 to 10%, depending on the retirement that you have. For example, if you drew out $15,000, there's a 10% penalty, which is $500 on the $5,000. Okay, I'm just using a 10%. Of course, on 5%, it would be different, right? So if you drew out $20,000, you would pay 10% on the $10,000, which is $1,000. You're subject to income tax because you didn't pay tax on that money, and there's typically a cool-off period, which means you can't contribute to your pre-tax retirement for 6 months to a year. So you get hit a couple times, right? But sometimes you're in a position where you might have to use the hardship. The reason why, you can draw out of it as a loan, and typically it's up to 50% of your contribution. If your retirement is new, most likely you don't have enough in your retirement, so you can draw only up to 50% of the contribution as a loan. So you might need more than that, right? So as a loan, it's typically due in 15 to 20 years. The payment doesn't affect your DTI. The interest rate varies. It all depends on when you draw from it, right, and who it's with. But the interest, check this out, goes back to you, the consumer. It doesn't go to your servicer. The interest goes back to you. And you're not subject to income tax, and there's no cool-off period. But you're only able to draw out only 50% of the contribution. Sometimes that's not enough for your down payment and your down payment closing costs. So sometimes I see people draw out of it as a loan and then also as a hardship for the difference of the money, right? Some people only need one or the other, right? Everyone's in a different boat. No answer is correct, all right? Hopefully that helps you out. So the next thing is how to draw from a post-tax retirement, right? So we talked about pre-tax. Let's talk about post-tax, right? Typically when it's post-tax, it's a hardship. There's no loan, right? From a Roth, you can pull up to $10,000, right? Without paying any fees or penalties or being taxed on it, right? For after the first 5 years, especially if you're using it to buy a home. Other types of post-tax retirement, right? Typically you can draw out your contribution. As long as you don't draw out the interest, you don't pay tax on it, right? Because don't forget, you already paid tax before you put the money in there. So if you draw from your contribution, you should be okay on post-tax, right? Of course, there's different types of retirements out there. This is general rules that follow most retirements. If you have something specific that you want me to look up, please leave that on the comment below, all right? So now, let's talk about your third type of qualified down payment, okay? Equity, right? Equity, and I got a story for you about equity, right? The first type of is selling your home. Use the equity when you sell your home. Let's say you owe $200,000, right? But the home is worth $500,000. There's $300,000 right there you can put towards your down payment. You don't have to use all that money, right? But remember this: make sure before you sell your home, you get a seller's net sheet, which is your seller agent's receipt. See how much it costs to sell your home. Make sure they include their commission. My buddy, I'm not going to say his name, I'm not going to try to embarrass him. He told me I have X amount to get into my new home, right? At the tail end. So we price it out, ended up being a regular VA loan, not a high balance. So he got a lower interest rate. But the agent didn't include their commission. When the agent included their commission at the end, he lost equity, right? Now it went from a regular VA to a high balance, which gave him a higher interest rate, which he didn't qualify. You know who ate all the crow? This guy, because I was his friend. But if I would have known that up front, we would have structured the deal a lot differently. And they're telling when he sold, he had to close on his other house, on his new home, right? So because of that, he didn't have enough. So make sure if you are going to use your equity from selling your home, you get a seller's net sheet. Make sure the real estate agent commission is in there. Most of the agents, they do put them in there, but there's some slick ones out there, right? Not all, just like lenders. There's some slick lenders out there as well. So I'm not just bashing on realtors. From a lender, you want to get a fee worksheet. See the breakdown to buy a home. You want to see cost to sell and cost to buy so you can budget, so you know what your new mortgage payment is going to be. If I didn't give my friend this lower rate, he probably wouldn't have qualified. We would have to pay off debt, a lot of things we had to do, but he was put in a bad position because he didn't have a seller's net sheet and he had a fee worksheet from someone else before he came to me. He just came to me at the end because he trusts me, but I'm thinking this other person had it approved. He just wanted to change lenders because he knew me and my rates were a little bit lower, but there's other things he didn't factor in. So his number was wrong, which made the whole deal almost go sideways. Okay, so your your equity you can use for down payment. Another source of down payment from your equity, is your home equity line of credit, which is very popular right now. As we're in a seller's market, equity is booming right now. Some people, they call it a HELOC, home equity line of credit. Typically, you keep your first mortgage since you're not selling. You draw a line of credit, which is the difference in your home. For example, the home is worth $500,000. Typically, you'll borrow up to $400,000, right? If your balance was $200,000, you can borrow another $200,000, right? But it's a variable rate. It's interest only. That means you can have a choice to make principal payment or non-principal payment. If you have questions, we'll answer the questions at the end. So thank you so much for everyone who's patient, okay? So there's a variable rate. It's a variable rate. It's interest only. But you don't start paying on the interest till you find your new property. So say you pull a line of credit. You won't find your home until 6 months later. You don't pay money on that interest till 6 months later. They're typically interest only for the first 10 years. After that, they turn to a 20-year amortized loan, not a fixed rate, amortized. The interest rate is typically prime plus your margin. Your margin on a home equity line of credit is based on your profile and how much money you're pulling out, right? For example, let's say your margin is 0.5%, but prime rate is 3.25%, so it's 3.25% plus 0.5% would make your interest rate 3.75. But it can change every time the feds meet. They can change the rate, right? So it all depends where they change prime at. So after 10 years, it turns into a 20-year amortized loan, so the payment does shoot up. Some people, they don't want to gamble, even though rates have been low on these lines of credit. So they get something called a closed-end second, right? They're not selling their house. They keep their first loan. They get a closed-end second. Typically, it's a fixed rate. It's a principal and interest payment. But you start paying on that interest ASAP. You draw the money out. If you haven't found a home in 6 months, you're already making principal and interest payments. Typically, the loans are amortized over 10 years, 15, 20, 25, or 30, right? Depending on, how you want to qualify, what payment you're comfortable with, especially if you're doing investment property. Some people will go with a 30 because they're using the renter to make the payment. And the fourth and final way to pull cash out of your house to buy a home with equity is a cash out refinance, right? Depending on what the rate is on your first, it might be worth pulling the cash out. Some people like that fixed payment. They don't want 2 payments, right? They do a cash out refinance. So those are the 4 ways to draw equity to buy home. Either sell it, home equity line of credit, closed end second, or a cash out. Now let's talk about gifts, right? We all love gifts out here, right? So the fourth type of asset you can use for your down payment is a gift, okay? Remember, gifts must be from a family member. It cannot be a loan. It must be a gift. You cannot use someone else's retirement as your down payment. And the gifts can cover down payment and closing costs. On FHA loans, the gift can cover credit cards and pay off bills. And all gifts are only for primary residents. So if you're buying an investment, you cannot get a gift, okay? There's a liquid gift. Same thing, the ability to gift. Just what we said when we talked about liquid gift, right? You have to have the ability. when you go from bank account to bank account or bank account to escrow, you got to make sure you have that ability to cover the down payment. Your donor does, okay? Remember, on a conventional loan, if you wire the money directly to escrow, the donor doesn't have to prove any bank statement. That's the only caveat, right? But if you send the money from one account, from the donor to the buyer's account, you're going to have to source that money. If you go with a government loan, you got to source everything, right? If you go from bank account to escrow on a government loan like FHA, you're still going to have to source it. And last but not least, gift of equity, right? If you are getting a home from a family member, that equity can be used to cover down payment and closing costs, right? On FHA loan, you can cover down payment, closing costs, and pay off all the buyer's bills if you want, right? So that right there is the fourth qualified down payment asset. And let's talk about the last one. The fifth one, very popular, down payment assistance. You can use down payment assistance as a qualified down payment. Typically, there's 3 types of down payment assistance. So if you get get down payment assistance out there through all 50 states, every state is going to have different variations of down payment assistance, right? It's going to be one of the 3. It's going to be either a loan, which means you borrow the money for down payment and you borrow the money for closing costs. You can get a grant. The money can be forgiven right away or it can be over time. Typically, when you're getting a grant, it's a higher interest rate, right? They're going to make up their money by you paying a higher interest rate, right? And then after a certain period of time, once they made their money, they're going to forgive it. Loans have lower rates because you still got to pay it back. So it's a little bit less than a grant. Not all the time that happens, but general rule, if they're going to forgive the money, the rate's a lot higher, right? That's a general rule. It doesn't mean it's always going to be that way, but it's very common. The third type of down payment assistance, which all you guys love until you read the fine print, shared equity. You'll see like such and such city is giving me 20% down. Oh my goodness, you're a loan, you're a grant. I'm getting 20% down. I have no PMI. But when you sell or refinance, they're tapping that equity, right? Tap, tap, tap. Typically, you'll see these shared equities. They'll give you 20% down. You're like, woo! But when you sell or refi, after a certain period of time, they're going to want to tap some of that equity, right? It's called shared equity. They rolled with you. You got to roll with them. So it sounds like a great deal, and it still is a great deal, but you have to remember, right? They are sharing the equity. That's why they gave you the money. I don't want to share my equity. Then get a loan or get a grant or come out of pocket for a down payment. If they're giving you that much down, it's going to be shared equity. So those are the 3 types of down payment assistance. So that right there is the 5 types of qualified down payment, right? Liquid, retirement, right? Gifts, equity, and down payment assistance, right? Hopefully that brought you a lot of value, guys. If I did bring you value, do me a huge favor. Save this video, share this video, and like this video. And if you're not subscribing yet, hit that subscribe or notification button ASAP. So now that you know what a qualified down payment is, the next step is, how much do you need to save? Like I said, if you want to finish a race, you want to know where the finish line is. You got to know how much you need to save for your down payment. Okay, we'll go over that in a second, Laura. So we got to find out, how much do you need as a down payment? Stocks, you can liquidate, right? Remember, if you can, anything you can liquidate, you show proof that you own it, you can use it to purchase, all right? So how much do you need for a down payment? I wish they would have taught me this growing up, right? It's by percentage, not by dollar amount, right? Unless you're chasing a specific down payment, it's all percentage based, right? So typically when you're buying a home, it's either going to be 0% down, 3% down, 3.5%, 5%, 10%, 15%, 20%, or 25%, depending on the program and depending on the property type. So remember, it is by percentage, not by dollar amount, right? Unless you're chasing a specific down payment or a specific monthly mortgage payment, all right? So remember that, all right? So let's look at our down payment cheat sheet really quick here. So, of course, new loan limits are coming out in 2022. This is filmed in 2021. Of course, we'll try to update this video as much as possible, but down payment, right? So 3% down, 3.5%, 5%, 10%, 15%, 20%. So you got to decide where you're looking to purchase. Once you decide that and you decide the program, what down payment percentage matches up. And now you have a goal of your finish line. Can you save this over X amount period of time? If it takes you too long to save it, prices will go up between 4 to 5% a year, right? It went crazy this year. I wouldn't count the 20% every year, right? But it's, let's say, 4 to 5% a year as you're saving, because now you know it's by percentage. Can you save that money quick enough? If it takes you 3 years, will you save fast enough to keep up with inflation and appreciation? Okay. Now that we know there's down payment cheat sheet, if you would like a copy of this, go to whatsamortgage.com and download our ultimate mortgage guide. Okay. So which program does what? Let's go with conventional. Okay. On a conventional loan, typically it's going to be when it says 95 to 97, it's either 5% down or 3% down with a primary resident, right? Primary residence, single family home, right? Condo or townhome, right? If you're going with a duplex, primary residence, 15% down, right? For a 2-unit, 3-unit or 4-unit, right? 80%. Some lenders are 75%, right? I blended this together. Some Fannie Mae and Freddie Mac does have a blend. Also, I blended it together because sometimes there's a Home Possible, Home Ready program you can get. But typically, well, I know mid 3 and 4 units are 25% down. This is primary residence, right? But if you fall under Home Ready, Home Possible, it could be 20%. Second home, 90%. First unit investment, 15%. To a 4-unit, 25%, right? Definitely talk to a lender. See if you qualify for Home Ready or Home Possible, right? If you don't, it's going to have different down payments. Depending on the program you're qualifying for, you need to look at the down payment percentage and the purchase price you're looking to purchase so you know how much you need to save. And you got to ask yourself, is this realistic? My rule of thumb, if you can't make it happen in 24 months, you might want to think about somewhere else to buy that's a little more affordable. Remember, you take a $500,000 purchase price. Let's say it's 5 for easy numbers, 5% appreciation every year. Don't forget, so 500,000 turns to 525, another 25. If I keep stacking 25,000, which should be more, right? Can I save fast enough, right? You got to ask yourself that. That's why some people say, you got to save 20% down. How long would it take you to save 20% down? Will that home be at that price? I had a buyer. I don't want to buy to have 20% down. He wanted to live in Fountain Valley. We did the math. If he saved $1,000 a month, he still wouldn't be able to do it in 5 years. I asked him, will this $800,000 home be at this price 5 years from now? Most likely no. I'm not trying to, kill his dreams, but I want him to see where the finish line is. I want you to see where the finish line is, right? I want to live in a 2-story home in Fountain Valley, right? With 4-bedroom, 3-bath, X amount lot. I'm like, okay, this is the purchase price. Well, I'm going to save for a bigger down payment to get my payment down. But by the time you save that down payment, right? Will the home be at that price? 20% down of 800 grand is 160. Okay, 5% down was 40 grand, right? He had the 5% down, but he wanted to save that we had the 160. Will that home still be 800 grand when you save your 20% down? But the only way for you to know is to figure out your down payment. Know the down payment percentage, okay? So these are conventional loans. Remember, these aren't exact down payments. There's Home Ready, Home Possible. I didn't pull up all the programs, but this is a blend. Next, let's go with FHA, okay? FHA, you'll see a standard 3.5% down, right? You can go 5% down if you want that cheaper PMI. You can go 10% down. These are typically for people who have under a 580 for FHA, or they can go 10% down because rates are so low. Like, you know what? Rates are at 2.25, right? Last year was at 2.25, or sometime earlier this year. Let's say 2.25. I'll do my 10% down because I'll wait for the 11th year for my PMI to fall off, right? A lot of people actually did that. I wouldn't do it now where rates are a little bit higher, but when we're at 2%, I'm like, you know what? Let me put my 10% down. I'm going to keep this thing long term because at 2.25, when you make a mortgage payment, you're attacking more principal. The amortization curve was lower, right? Everyone's situation is different, right? But now you know the down payment percentage for conventional, for FHA, and let's look at USDA and VA. 100% financing, right? If you're a veteran, USDA, right? You don't have to worry about down payment. You just have to worry about closing costs. Or you can take a higher rate to cover your closing costs. The cool thing about USDA, if the home appraises more than the purchase price, you can use that money to cover closing costs. There's a lot you can do. But the most important thing out of all of this, talk to your lender, find out, hey, what program do I qualify for? What's the minimal down payment, right? As you're out there on your home searches, looking for homes, Zillow, Redfin, Homes.com, your realtor's home search. look at the purchase price, find out the minimal down payment. Is it reachable, right? Do you already have it? Some of you guys already have it. Should you save a bigger down payment? Talk to a lender. Numbers don't lie. People do. Run the numbers, right? If you're not there, oh, I want this house, like this other person. Can you save money fast enough to beat appreciation and inflation in that area? If not, you might need to have a rude awakening and you might have to live somewhere else. I think more and more people are coming to that realization. That's why they're looking at the Idahos. Idaho's popping. Nevada's popping. Arizona's popping. Texas is popping, right? All these areas are popping because people are waking up like, whoa, I can't save money fast enough, right? And we're overly populated in California. If you're in California, right? California has 44 million people. The second largest is Texas. Third largest is Florida. Did you know it takes Florida and Texas combined to beat California? Florida and Texas combined, I think, is 50 million, and California is 44, right? Think about that. So you see people leaving because it's just getting too expensive. You might not live in California, but are you currently renting in a metropolitan area, right? Are you being pushed out because rents are rising? And because rents are rising, people are buying, which are driving up prices. And like, can you save fast enough? These are the questions that you got to ask yourself. And these are the things I wish they would have taught in school, but today that's what I'm teaching, okay? Remember, lastly, only time you don't save by percentage is when you're chasing a specific down payment or you're bringing down that DTI or a specific mortgage payment. And remember, you always have to make the minimum down payment first, right? So let's say you're going, the minimum down payment for FHA is 3.5% down. But like, I want that specific payment. You increase your down payment, right? To get your payment you want or to bring down your DTI, you at least have to meet the minimum, right? If your program is minimum 5% down, you got to at least meet the minimum. For investment, 25% down, you got to meet the minimum. Or you meet the minimum, you don't qualify because your debt to income ratio, you're going to have to bring in a bigger down payment, but at least meet the minimum. All right. So it's important that you know these things, right? Now, first you got to find out what is your qualified down payment, right? Once you find out what you can use, then find out how long is this race, right? What's the minimal you got to run in this race to win? And do you already have it? And if you don't, how long does it take for you to save, right? People are saving money aimlessly, not knowing how much they need to save. They're saving, you're working hard, you're saving, you're just keeping your head down, right? Raise your hand, right? Comment below. Raise your hand. Are you just saving aimlessly? Or do you know how much you're saving? For what? Most people don't know for what. They're just saving. I'm saving $1,000 a month, $500 a month, 25. They're just keeping their head down, right? And they're not looking up. When will this race end? I don't know about you. I am not Iron Man. I'm not indestructible. There is fatigueness. But the best way for you to manage your fatigueness is to know where is the race. Know the down payment, right? How do you win a race? Know how far it is. All right, guys? Hopefully this video brought you a lot of value. Do me a huge favor again. Save this video, like this video, and share this video. If you're not following us by now, that's a no-no. Hit the subscribe and notification button, okay? So you're notified every time we post this new content. This series is coming to an end soon, right? People ask me all the time, man, I want to buy a house. Where do I start? We start out with credit, debt to income rate. We start out with debt to income ratio, credit, income. We have down payment. We're going to go over a mortgage payment next. And then we're going to go over closing costs. Then we're going to go over different do's and don'ts, the home buying process, different loan programs. Once I'm done with this series, it will be packed so that we can forward it out. But once the series is done, unless there's an update I need to correct, I will correct it, right? But typically this series will end. You do not want to miss out. I might do a little updates for 2022, but most likely I make sure this information is as evergreen as it can be. I might have to change sections here and there, but do not want to miss this session. It will be on our playlist in about 3 to 4 weeks, all right? Get ready for it. Also, what comes with this playlist? Ultimate Mortgage Guide. We are updating our guide right now. After 4 years, we finally compacted all, right? All the little changes here and there. We finally have an ultimate Mortgage Guide that goes with our playlist. You don't want to miss out on it, all right, guys? So let's go some Q&A here. You have questions, I got answers. Mary Jane, I got approved by the underwriter last September 10th for a newly construction home worth $525. Now ready to clear. Unfortunately, construction delay, but the lock of 2.875 will expire on 12/3. Together with the underwritten approval, what is your suggestion? Do you think it will affect the entire loan? If they don't extend your lock, right, your rate will go up, which will change your DTI. Since the builder is making a mistake, I would ask the builder, are you paying for my lock extension? Right? If you qualify for 2.875, talk to your lender. Do you have wiggle room? If you don't have wiggle room, you got to pay whatever it takes to keep that 2.875. But if there's wiggle room, you might have to go up in rate a little, but talk to your lender. If it's their mistake, make them make it right. All right? Hopefully that helps you out, Mary Jane. Guy, I have 2 pension plans. It's strictly for educators. That is correct. Walden Stone, what are your thoughts on 10-1 ARM interest-only mortgage for the Bay Area? I like 10-1 ARMs. Walden, what?
Yeah, go ahead and answer.
Walden Stone, what are your thoughts on 10-1 ARM interest-only mortgages for Bay Area? I like them. Interest-only loans are for people who are responsible and they know they're going to be in that loan for a short period of time, right? Especially if they know they're buying in the Bay and things keep appreciating, they're making the minimal payment because they know the homes are going to appreciate. There's a chance it doesn't appreciate, but people who are doing a 10-1 ARM, before they even give it to you, they know you have a high net worth and you have a lot of reserves. If you qualify, Walden, most likely you can handle it. I do like them, right? If you are a mover or you can pay down chunks of principal at a time, I would take it. But if you're on a low fixed income and for some reason you found a way to qualify for 10-1 ARM, I wouldn't mess with it, okay? It all depends on your situation. Hopefully that helps you out, Walden. Mary Jane, I already answered that question. Okay, thank you so much. Laura Bermudez, what about your stock account? Yes, remember, if it's a stock account, you have to show proof that you own it. When you liquidate it, when it leaves the trader's account into your account, there are going to be all the fees. Get the proof of you liquidating it. Whatever account it goes to, you're going to ask for proof of that bank statement. You will be fine. Thank you so much, Terry. Terry's a loan officer. Hopefully you learned a lot. What's the average increase of APR to cover closing costs? Gus, it all depends. Remember, FHA and VA have the VA funding fee or the upfront MIP. It could be different, right? Also depends APR. It all depends on how much your closing costs is. Some people are financing everything. Some people are financing a little bit. Also, with the lower purchase prices, the APRs are a lot higher because you have to take a higher rate because the flat fees make closing costs higher. It varies, Gus. Sorry, I can't give you a direct answer. If I knew a little bit more, if you want answers, do me a favor. Give us a call, 714-790-9697. You can give us a call. If you're a shy guy or shy girl, you want us to help you out, send us a text, right? You can message us through Facebook or send us a text, 714-790-9697. Call, text, or email us at info@what'samortgage. Hopefully that helps you out. We scheduled to close on February, but lender wants to see all the funds 2.5 months prior to closing. We will be using our 401k funds, but we're planning to withdraw from our 401k supposedly mid-January 22. So what amount will not be available to our bank account until then? Will the lender still consider a 401k even if it's not yet withdrawn? Yes. 401ks are quirky, right? Some servicers are old school. They still mail a check. A lot of them wire. Yes, they still consider it, but you want to get that approval ASAP, right? Take your loan estimate or your HUD, show it to your 401k. Maybe show them the 401k approval that you're going to get approved for the funds, right? And then 401k will want to know when you finally are closing, then they'll release the funds. All right, hopefully that helps you out there. Joffrey Masungi. Jose Rincon, first-time homebuyer in California, looking for the best program. If you're looking for down payment assistance, the 3 top dogs are Chenoa, CHENOA, which is a nationwide down payment assistance program, Cal HFA, and GSFA. Those are the 3 best down payment assistance programs if that's what you're looking for, Rincon. Jose. You're welcome. You're welcome, Chris. Betsy, what's good, girl? Haven't seen you in a while. We are buying a house. What page do I need to look at to make sure I am not getting overcharged? If you're doing down payment, so you want to look on the loan estimate, page 2, section A and B. If you're doing down payment assistance, you will see an origination charge. If you're buying down points, you should see origination charge. If you're not buying down points and you're not doing down payment assistance, page 2, section A, if you're getting a par rate, should be under $1,800. If you're over $2,000, you're getting waxed. Page 2, section B, right? That should be a couple $100. Don't include the appraisal and don't include the FHA funding fee or MIP or the VA funding fee. Okay, should be a couple $100 for your credit, your flood cert. Shouldn't be too crazy. You want to focus on page 2, section A. If you're getting a loan through a broker, page 2, section B, that's where you'll find your processing bill. You'll see, oh, section A is really low. They put the processing in section B. Banks put it in section A. Hopefully that helps you out. Harry Bennett, hello, new MLO here. Love your content. Great job. Can you shed some light on construction loans, one-time closed loans? Harry Bennett, I do not specialize in construction loans. I've done one my whole career, and when I was working at US Bank, they did the whole thing for me. There was a whole department. I just got them the loan application. So if you are a mortgage if you're going to work for a mortgage broker, they'll typically give you more information on it. I worked at a bank. I did one construction loan. Just keep it 100, all right? What up, Mary Jane? What up, Walden? Karen, what's good? Thoughts on construction loan? New to all of this. Construction loans, typically, I've done construction to perm, but not straight up construction loans. If it was me, I'd reach out to the big banks. Some brokers do specialize in construction loans. I just haven't done them. Just keeping it 100. Thank you, Vincent. Chris, you have 2 checking accounts. One's primary. Chris Soto, I have 2 checking accounts. One is primary and the other set aside for school and mortgages. Will this cause confusion when they provide liquid out? Should I use only one account? It's fine if you provide both. They're just looking for funky deposits. If you don't have funky deposits, you should be okay. You're welcome, Joffrey. Thank you, Jose. You have a 3 1/4, Tom? Not right now. Unless you're going to get a 15-year fix, right? At a 30, you're going to pay some crazy fees to go get something respectable in the 2s right now for a 30-year fix. On a 15, I would do it on a 15, not on a 30. Tony Green, can you combine down payment assistance with a preferred lender? Typically, that preferred lender should be able to provide it for you, but it would be hard. Typically, you go with a preferred lender, the seller is already covering your closing costs, or the lender is, right? So you should be fine. You got to come up with your down payment. Or just go straight up and do down payment assistance, right? Ask the preferred lender, do you do down payment assistance or a grant already? All right, hopefully that helps you out. Knew this, hopefully following you for a while. Thank you so much, Tony. You're welcome, Betsy. Violet, what do you mean funky deposits? So what I mean by funky deposit, let's say you have a $5,000 cash deposit and it's cash. You have no proof where you got it from. Or like my cousin Sal, I'm not trying to pick on you, Sal, right? Violet Sal, right? My cousin Sal owed me $5,000 and I deposited. Well, you need to show proof that you gave your cousin Sal $5,000. I have no proof that I gave him $5,000, right? It was in cash. That is a funky deposit. If you can't show proof on how you got the money, and if it's cash, you better show proof that you either own something you sold that was that same amount of money that you deposited, or if you lent someone the money, you better have a check to show proof that you loaned your cousin $5,000 and they gave you $5,000, right? Where's my $5,000? Thanks, Sal. That's funny. You're welcome. Guys, I see a lot of you guys asking about construction loans. So I will do my research on my construction loans and I will talk about it. Typically with our Ultimate Mortgage Guide, once you understand the foundation, you can qualify for any loan. Construction loan, construction to perm, land loans, just understand the foundation. So typically on a construction loan, I'll look up what is the max LTV, and with construction loan, are they like renovations? How do they release the money, right? Do they release it in certain phases, right? And what's the qualification? Typically on construction loans, right? There's going to be a max DTI, a max, there's a minimum credit score. Those are easy. We just got to see what's the minimum down payment, like a land loan. Perfect example. Land loans, the minimum down payment is going to be 30 to 40% down, right? So it all depends on the program, but I will look into it, right? That's something we'll be talking about soon. But guys, I really appreciate everyone who saved this video, shared this video, and liked it. If you didn't yet, phooey on you. If you watched till now, hopefully I brought you enough value. Please save, share, and like this video. If you're not following us by now, please hit that subscribe and notification button. All right, guys? We want to end all our videos and our streams with our attitude is gratitude. Without all of you, there will be none of us, right? So thank you guys so much, and